Welcome back to the deep dive. It is Tuesday, February 10th, 2026. And if you've been watching the ticker tape today, you might have noticed a lot of green.
A whole lot of green.
But there is one specific corner of the market that isn't just participating in the rally. It's practically sprinting away from the rest of the pack. We're talking about the lodging sector.
It really is the standout sector right now. We're dead center in the middle of earnings season, and the volatility we're seeing in hotel stocks is, well, it's fascinating. It's giving us a huge amount of data, not just about the companies, but about the state of the consumer.
That's what jumped out at me when we fired up the stock screener this morning. We sorted by volume, by market cap, and we filtered for the biggest movers.
Yeah.
And the top three, the heavy hitters in the hotel game, are all telling a very specific story today.
And it's a great lineup.
Yeah, we're looking at Marriott International, Hilton Worldwide Holdings, and then this really interesting outlier from China, A-Tour Lifestyle Holdings.
It is the perfect lineup to analyze because you have the immediate aftermath of an earnings report with Marriott, you've got the pre-earnings jitters with Hilton, and then, a pure growth play with A-Tour. It covers the whole spectrum of how the market functions.
Before we get into the weeds, and we are going to get into the weeds with technicals, price action, and even a paper money simulation, I do need to get the legal housekeeping out of the way, and I'm only going to say this once.
Go for it.
We're going to be discussing specific financial data, buy and sell signals, and real-time prices. This is strictly for informational and entertainment purposes. We are not financial advisors, and this is not financial advice. Do your own homework.
Absolutely. Context is everything.
So let's set the stage. Why are we zooming in on these three right now? What's the mission of this specific deep dive?
Well, the mission is to use the lodging sector as a barometer for the economy. Specifically, we want to test this theory of the K-shaped recovery. We've got Marriott reporting today, Hilton tomorrow, and A-Tour showing us the Asian growth narrative. So we need to break down the basic and technical analysis for each, check the valuations to see if they're getting too expensive, and then run that paper money simulation to see what a $5,000 investment would actually look like based on today's action.
I love the paper money challenge. It takes the abstract percentages and turns them into actual dollars. So let's dive right into the deep end with the big story of the day. Marriott International, ticker MAR.
The heavy hitter.
The heavy hitter is right. If you pull up the chart for Marriott today, it's essentially a vertical line. It's trading at $359.35 as we speak. That's up $28.14.
In a single session.
In a single session. We're looking at an 8.5% jump.
For a company with a market cap of over $96 billion, that is a massive move. You usually see that kind of volatility in tech startups or biotech, not in a mature hospitality giant.
But here's where it gets confusing for the casual observer. I looked at the actual earnings print this morning. They released their Q4 report, and they actually missed their EPS estimates. They posted adjusted earnings per share of $2.58, and Wall Street was expecting more.
Right. And usually that's a recipe for disaster.
Exactly. Usually when you miss the bottom line, the algos sell you off. Why is Marriott rocketing to the moon?
This is the classic lesson in windshield versus rearview mirror. The earnings miss was about the last 3 months. That's the rearview mirror. It's done. But the stock market trades on the windshield. What's coming next?
So the guidance.
It's always about the guidance.
Right.
While they missed EPS, they did beat slightly on sales with $6.69 billion. But the real rocket fuel was the guidance. They accelerated their room growth outlook for 2026. Basically, they're telling the market, we're going to open more hotels than you thought.
And the credit card royalties.
And crucially, they improved their credit card royalty economics. That is pure high-margin cash flow. Investors looked at that 2026 roadmap and just decided the Q4 earnings miss was irrelevant noise.
There was also a specific comment from the CEO, Anthony Capuano, that I think explains the macro picture perfectly. He explicitly mentions seeing a K-shaped economy impacting the travel vertical.
That was the most important thing said on the call. A K-shaped economy means the economic reality is splitting. The upper arm of the K, the wealthy, they're doing great. Their assets are up, their portfolios are up, and they're spending money at Ritz-Carlton's and St. Regis properties.
And the lower arm is pulling back.
Exactly. Marriott is effectively saying, we are betting on the top of the K.
And to back that up, they're planning to return over $4.3 billion to shareholders next year. That is a lot of confidence for a company talking about a split economy.
It's a huge signal. It tells investors, we have the cash, and we're giving it to you.
Okay, so fundamentally the story is rich people are still traveling. But let's look at the technicals. If I'm a trader looking at this chart, what am I seeing?
You are seeing what we call a blue sky breakout. The stock is at 359. The previous 52-week high was 333.96. We've smashed through the ceiling. There's no historical price resistance above us because the stock has literally never been here before.
Which is exciting, but also, terrifying.
It is. The air gets thin up here. Look at the moving averages. It's trading almost 29% above its 200-day moving average. That is a massive gap. It suggests the rubber band is stretched very, very tight.
And I'm looking at the RSI, the Relative Strength Index. It's sitting at 75.84.
That is the caution flag. For listeners who don't stare at charts all day, think of RSI like a speedometer. It goes from 0 to 100. Anything over 70 is considered overbought.
The engine's redlining.
The engine is redlining. An RSI of almost 76 basically tells you the buyers might be exhausted.
Yeah.
It signals that the easy money has been made in the short term. It's often a sell signal, or at least a hold signal, for swing traders. It implies a pullback is likely imminent.
And let's talk valuation. TE ratio is 37.85. That feels rich for a hotel chain.
It is rich. That is a tech stock valuation. Now, the forward PE drops to about 28 because of that growth guidance, but you are definitely paying a premium. However, their return on invested capital ROIC is 21.3%.
That's very efficient.
It tells me they're very efficient at turning capital into profit. You're paying a Ferrari price, but you are getting a Ferrari engine.
All right, let's make this real. It is time for the $5,000 paper money challenge.
Let's run the numbers.
Okay, here's the scenario. You're a trader, high risk tolerance. You had $5,000 in your paper trading account yesterday. You saw earnings were coming up, and you decided to bet on Marriott. You bought at yesterday's close of $331.21.
Holding through earnings. It's basically a coin flip. Very risky.
So take $5,000, divide it by 331.21. That gets you approximately 15.09 shares.
Okay, so you're holding about 15 shares.
You wake up this morning, you see the earnings miss, you panic, and then the stock rips on the guidance. Today, the price is $359.35. That 8.5% jump means your $5,000 investment is now worth roughly $5,425.
Not bad for a day's work. Not bad at all.
You made a profit of $425 in a single trading session.
That's a fantastic return.
Yeah.
But the takeaway here is that you were saved by the guidance. If the CEO had been gloomy about the economy, that 8% move could have easily gone the other way.
High risk, high reward. Now let's move to the second heavy hitter on our list. This is the sympathy play. Hilton Worldwide Holdings, ticker HLLT.
Ah, the anticipation trade.
Hilton is the second largest by market cap, around $75 billion, and today it's trading at $323.70. That is up $967, or roughly 3.08%.
So Hilton is drafting. Think of it like NASCAR. Marriott is the lead car pushing through the air, and Hilton is tucked right behind them, getting pulled along. Investors see Marriott surge, and they just assume Hilton will have similar good news.
But there's a massive catch. Hilton hasn't reported yet. Their earnings are tomorrow, Wednesday, February 11th.
Exactly. So people buying today are betting that tomorrow's news will validate today's price.
And looking at analyst sentiment, expectations are already sky high. Goldman Sachs had a buy rating with a target of 317. We are currently trading at 323.
We already passed the target.
The stock has already surpassed the target before the report even drops.
We call that priced for perfection. When a stock is trading above analyst targets before the news, there's zero margin for error. If they report good numbers, the stock might actually drop because the market was expecting great numbers.
That makes me nervous. And looking at the technicals, Hilton looks even more stretched than Marriott.
Much more. Marriott had an RSI of 75. Hilton's RSI is at 78.16.
Whoa, approaching 80.
That is deeply overbought. I mean, technically that is screaming pullback risk. If I'm a conservative trader, I look at an RSI of 78 right before a binary event like earnings, and I'm taking some chips off the table.
And the valuation is even steeper.
Significantly. Marriott was expensive at 37 times earnings. Hilton is trading at a PE ratio of 46.91.
47 times earnings for a hotel.
It's incredibly high. And look at the PEG ratio, price to earnings to growth. It's sitting at 2.6. Typically, a PEG over 2 suggests the stock is expensive relative to its growth rate. So with Hilton, you are paying a massive premium for the hope that tomorrow's news validates the price.
It sounds like the market is pricing Hilton for absolute total perfection. Okay, let's run the paper money simulation on this one to compare.
Let's do it.
Same scenario. You have $5,000. You bought Hilton yesterday at the close, which was 314.03. That 5,000 gets you a few more shares than Marriott, about 15.92 shares.
Right.
Today, the sympathy rally pushes it up 3.08% to 323.70. Your profit is roughly $154. Your total account value is $5,154.
So a decent gain, but nowhere near the Marriott windfall.
And here's the dilemma for our listener holding that paper position. You've made $154. Do you sell now and lock it in, or do you hold through tomorrow's earnings with an RSI of 78 and a PE of 47?
That is the nail-biter. It's a high-stakes gamble. Marriott had the news to back up the price. Hilton currently only has the hope of news backing up the price. If Hilton misses, or even just meets expectations without raising guidance, that stock has a long way to fall.
It feels like picking up pennies in front of a steamroller. Okay, let's shift gears completely. We're leaving the U.S. giants and their sky-high valuations. We're heading overseas for our third pick. This is the outlier. Editor Lifestyle Holdings, ticker ATAT.
The China play.
This is a much smaller company, a market cap around $4.5 billion, but the volume is huge. It is trading today at $39.84, up about 50 cents or 1.27%.
And this is a completely different animal. Marriott and Hilton are mature global dividend payers. Editor is a growth stock focused on the upper mid-scale market in China.
And unlike the others, this isn't an earnings play today. They reported back in November. So what is moving this stock?
It's largely sector sentiment and recognition. You have analysts like CLSA initiating it as a premium alternative in China's market. It's named an IPO stock of the week back in late 2025. It's just slowly gaining traction as the go-to stock for exposure to the Chinese domestic traveler.
So let's look at the chart. Marriott and Hilton are smashing all-time highs. What about Atour?
Atour is actually consolidating. It's trading at $39.84, but its 52-week high is $43.17. So it hasn't broken out yet.
Is that a bad thing?
Not necessarily. For a technical trader, it might actually be an opportunity. Look at the RSI. It's at 57.24.
That's pretty much dead neutral.
Exactly. It's not overbought. It has room to run. It's fighting to hold its 50-day moving average, but it is comfortably above the 200-day line. A technical buy trigger here would be a breakout above that 43.17 resistance level. Right now, it's just coiling, building energy.
Now, you were getting excited about the financials on this one earlier. What's the value argument here?
Oh, this is where it gets fascinating. Remember, Hilton's PEG ratio was 2.60, suggesting it's expensive.
Right, way over 2.
Atour's PEG ratio was 0.73.
Whoa, under 1.0.
Yes. A PEG under 1.0 is the holy grail for growth investors. It implies the stock is undervalued relative to how fast it's growing. You are paying less for every unit of growth.
And the growth numbers are real.
They are. Their gross margin is a massive 43.67%. And their return on equity ROE is a staggering 45.85%.
45% ROE. That blows the U.S. giants out of the water.
It shows how efficient they are at using shareholder capital to generate profit in that expanding Chinese market. And the PE is 27.3, which is significantly cheaper than both Marriott and Hilton.
So you're paying less for more growth, essentially.
On paper, yes. The risk, of course, is geopolitical and macroeconomic risk within China. That's why it trades at a discount. But strictly looking at the math, it's the value pick of the bunch.
All right, let's run the final paper money simulation.
Let's see the P&L.
You take your $5,000. You bought ATAT yesterday at the close of $39.34. Because the share price is lower, you get a lot more volume here. You pick up approximately 127.1 shares.
A nice stack of shares.
Today, it's trading at $39.84, a modest move of 1.27%. So your profit is roughly $63.50. Your total value is $5,063.50.
So it's the smallest winner of the day in terms of raw dollars.
Right. Marriott made you $425, Hilton made you $154, Atour made you $63.
But ATAT was the least volatile. It has the lowest RSI. And the valuation metrics suggest it might have the most runway left for the long term. Marriott and Hilton felt like a sprint today. A-Tour looks like it's training for a marathon.
That is a great way to visualize it. So let's recap our winners podium for this Tuesday deep dive.
In first place, clearly Marriott. The big winner with $425 profit on a $5,000 bet, driven by guidance, dividends, and defying the EPS miss.
In second place, Hilton, the runner-up with $154 profit. Riding the sympathy wave, but sitting in a very precarious overbought position ahead of earnings tomorrow.
And in third place for today, but number one for value metrics, is Abor. $63 profit, but sporting a PEG ratio of 0.73 that demands attention.
So synthesize this for us. We have the whole sector moving. What is the big takeaway for someone listening to this?
Well, the lodging sector is currently split into two very distinct narratives. On one side, you have the U.S. giants Marriott and Hilton. They are trading at all-time highs with very rich valuations, PEs of 37 and 46. This is all driven by the belief that the K-shaped consumer, the wealthy traveler, will keep spending no matter what.
It's the safety trade. People are paying a premium for reliability.
Precisely. On the other side, you have the China growth play, A-Tour. It's trading at a discount to its growth. The big question facing this sector is, can the U.S. consumer actually sustain these prices? When you see RSIs hitting 76 and 78, that is the market screening perfection.
And perfection is a very hard standard to maintain.
If there is even a tiny crack in the travel economy, if that K-shape starts to crumble at the top, these stocks have a long way to fall. We are at peak optimism right now.
It really makes you think about that CEO comment again. Marriott warns about the economy while simultaneously raising guidance. Are we seeing a permanent shift in who can afford to travel? Is the golden age of travel just becoming the gilded age for the wealthy few?
That is the billion-dollar question. And the charts will tell us the answer sooner rather than later.
We will be glued to the screen tomorrow to see if Hilton can hurdle that high bar. Check your portfolios, check your paper trading apps, and be honest with yourself. Would you have held Marriott through earnings?
I don't know if I would have had the stomach for it.
Thanks for diving deep with us today. We'll see you on the next one.
Safe trading.